What happens if my income decreases in the future? Could using a HELOC instead of a mortgage put me at a greater financial risk?
Well, any scenario could. So again, let's critically think about that question. Your income goes down. That is neither good in the HELOC world nor is it good in the mortgage world. So conversely, because we 99.9% of Americans are consuming a mortgage. So you ask the question thinking that the HELOC, which is the alternative to a mortgage, not the only alternative, but it's one of the major alternatives to financing real estate other than a mortgage. You ask that question thinking that it's inferior. Well, what if my income goes down? Well, let me reverse the question. If your income goes down and you're in a mortgage, is that good? Do you have any flexibility? No, okay. But in a home equity line of credit, you've at least got some flexibility there. So the original question was, if your income goes down in the future, is it worse to have a HELOC than it is a mortgage? Yeah. Income going down, I can't imagine a situation that's ever good. So I'm not going to paint the picture that it's okay in the HELOC world. It means you're less efficient. It means your cash flow positivity also went down, assuming that if your income went down and your expenses didn't go down at the same rate as your income, then you've lost cash flow positivity, which means you're not reducing the balance of your home equity line of credit nearly as much as you were before. Well, that's not a good situation, but neither is a mortgage. But you lack the flexibility in a mortgage that you do in a HELOC world.